Hey everybody, Jeremy here, Sunday, July 16th for our weekly market bias update. So 2 weeks ago, I'm going to start out with a little bit of a review. 2 weeks ago, back here on Sunday the 2nd, I had said in our weekly market bias report that we had this potential breakout here, but I thought the bulls were overextended and needed some pullback. We got that in the previous week, and the next target that I had set at that point right here, if we did get a breakout, was up to the 45.50 level. However, last week down here at the bottom, on Sunday when we were doing the video, we were actually breaking this 20-period moving average. And I said I was actually leaning a little bit towards the bears. I saw this as maybe a double top potential reversal pattern. We were breaking that 20-period moving average. And this is a really good lesson to us in terms of allowing our market bias to update as we get more information. The following day, we ended up closing with this hammer candle here, which is a bullish candle. We had reclaimed that 20-period moving average. And so at that point, the market bias needed to be updated again to bulls coming back in and potential higher prices to follow. We also got this cross of the MACD signaling that bulls potentially had come back in, and we got a higher volume spike. So even though here I had called potential for a breakdown, we always have to be flexible and we have to be able to trade what we see in the chart. So at that point, bulls did step back in. We got our confirmation the following day. And at that point, then reverting back to our bullish bias as a potential breakout of this 4,500 level, 45.50 became the next target once again. We actually crossed that just a little bit. We hit 4560.5, and now we are looking for a little bit of a retrace. We have an inverted hammer, which is the exact opposite of the hammer candle here. This inverted hammer, you'll see if I zoom in, the hammer candle, we have a small candle body with a longer wick found at the bottom of a pullback, and that shows that bears had control, they lost control, and the bulls came back and fought back to the moving averages again. Then we got confirmation, rode it higher to our next resistance line, and now we have the exact opposite. We have a candle that the bulls did have control, they weren't able to hold it, and they gave that control back up. And now it has pulled back and it closed slightly lower for the day with a small body here and the larger upper wick. So this is now a reversal candle showing lower prices to come. So today we are expecting pullback for the first part of this week. We are expecting prices to retrace, and it's a matter of momentum now to see what happens from there. The most bullish case here would be a pullback down into this rising 9-period moving average that correlates with our previous breakout channel. This is our horizontal support level, and the moving average represents a rising support level. These moving averages, both the 9 exponential moving average and this blue line, the 20-period simple moving average, act as support, but they are dynamic, so they continue to move as new price points develop, right? So these ones are moving higher. The horizontal one, obviously, since it's horizontal support and it's based on actual pivot points in the chart, it remains the same. And now these two are converging on one another. So the most bullish case that we could make right now is if price pulls back today, tomorrow, to start the week, comes down and touches on that, gives us another signal candle similar to either this inverted, this hammer candle here, or maybe a doji candle. A doji candle is like this, where it has an upper and a lower wick with a small body kind of in the middle. I'm going to zoom in on that so you can see, like right here. And then prices are rising up, signal candle, prices going down, right? So the most bullish case, pull back into this rising 9, equaling around that 4,500 horizontal level, and then prices continuing to lift off from there. Base case from there has to be up to about 45.85, maybe all the way up to 4,600. If we do get a deeper pullback, this will actually remain bullish. Now that we have this completed pattern, it's switched from a potential double top with a breakdown. Now this is actually a completed cup and handle pattern, which is actually a continuation pattern. Continuation patterns usually mean once they trigger, that price is going to continue in the direction of the previous trend. The previous trend was setting higher highs and higher lows, higher highs, higher lows, higher highs, higher lows. Then it consolidated for a while. Now that we've broken out of that, if we come back and test and hold, we are now setting another higher low, right? Higher low coming down, and a higher low here would mean our confirmation has to be to the upside once we get a confirmation candle signaling prices are rising once again after this pullback repeats, completes. If we do continue to get a deeper retracement at this point, since we have the continuation pattern completed here, really we would have to take out the previous low all the way down here at about 44.11, 44.10, somewhere right in there, to destroy this uptrend on the daily chart. And I specify that as the daily chart. This is also a good teaching moment, because if we go back out to the weekly chart, we really wouldn't be breaking anything necessarily if we came down to that level. Really, the signal on the weekly chart for whether or not this bullish uptrend is still intact wouldn't be until the low of this last actual pivot down here. And that is actually a low of 4,368. So let's just say 4368. 4365, somewhere in there. I usually give a zone instead of an exact number, because price points, when you're dealing in the thousands like this, are not exact. They are kind of a support zone. But for the weekly chart uptrend to break, we would have to break below that, and we would also have to have enough time going to the right-hand side here that this point actually was below our diagonal trend line here as well. So at this point, we might end up having divergence from the daily chart in the weekly chart based on how the pattern develops and how much time it takes to develop. But since we have the completed pattern here and stable momentum increasing, meaning that from the low here to the high here, this distance, the price ran basically the same amount from the low here to this pivot high here. So we're not seeing a decrease anymore in terms of that pivot relationship. Last week, we had run from the consolidation base low here all the way up to here, and that was a much larger price movement. You can see if I drag this up, it was, maybe another 40% higher. So when we saw this pivot here, that was a decrease in momentum. So I hope that is a really good teaching moment for everybody, because we have to be able to update our market bias as we discover new information. And when we got this trigger candle, signal candle here, and the confirmation candle to follow, our micro bias then had to reset to what we were calling here for the breakout. So we have to be dynamic in that. As a side note, I continue to get more and more skeptical of higher prices the higher we go. And so because on the weekly chart, we have really seen a run from back down, what is this? A low of basically 3,800 all the way up to 4,561 here in the course of like 4 months. That is a massive run, and we usually don't get that overextended from our long-term moving averages without some kind of a pullback and retest or an elongated consolidation. So the further up we go, the further closer towards these all-time highs we go, the more and more skeptical and the more and more defensive I usually play, even if we do get these breakouts. I was very timid when I saw this confirmation candle here. One, because the confirmation happened, and then we immediately have this double top here that potentially can act as resistance again and roll us over. And two, if you are a more conservative trader and instead of playing the retracement, you wait for the breakout, then all of a sudden you're not buying until all the way up here at 4,500. And then there's not a very big potential profit zone up to that 4,560 or 4,550 potential resistance zone that we were looking at previously. And so there just wasn't a very big, clean window to the upside to play. So I hope that helps in terms of updating your market bias as the week progresses between these videos. So with that said, going into this week, we do have a signal candle here, an inverted hammer. We are expecting a pullback at least to this 4,500 level, potentially deeper than that. We're going to have to monitor it throughout the week. We do have important data coming out here, but not much. Monday, we have the state manufacturing index. I'm not expecting that to really do a whole lot to the market. And then we do have core retail sales. That's probably going to be the most important thing between the two of them. Unemployment claims on Thursday will also be important, but I think we kind of know the trend that this has been going under. It's been just slowly ticking higher here. And so I'm not expecting that to do anything but continue that trend, and therefore it's not going to be very shocking to the market. But just to point out, we do have some data coming out this week, but I think it's going to be less heavily dependent on these economic factors for news events based on the economy, and it's going to be more focused on earnings. So this week we are actually cooking off the earnings again going into the third quarter, and that always starts out with the financial sector. So basically any trading within XLF, the ETF that tracks the financial sector, is off limits this week. We also have earnings on Tesla, and we also have earnings on Netflix. Those two are very big companies that drive the market heavily. So watch those two companies to see how their earnings play out, because that can oftentimes give a signal as to how the market is going to react to earnings throughout the rest of earnings season. So let's go on real quick and go through the rest of our indexes here. Going out to the NASDAQ. The NASDAQ, we did end up breaking out of this little rising wedge pattern. Now, base case, pulling back into the 9 and into this horizontal support zone around 15,500. From there, we're basically just going to be waiting for another signal candle. So until we see a signal candle and then a confirmation candle showing the price is moving back to the upside, we have to be patient and we have to let this potential retracement play out. Whether or not it finds support at 15,500 or if it pulls back into this rising diagonal support, we'll have to see. If this breaks below and closes below the pivot low right here from last week, which correlates to just above 15,000, it's 15,063. If we break below and close below that, that is going to be the bearish signal where really we can be confident that the daily chart on the NASDAQ has broken, and now we might have divergence in terms of time frame analysis from the daily to this weekly chart. The weekly chart hasn't really given much of an actual pullback in an actual swing low until way down here at like 13,000 basically. So it's going to be hard to analyze pivot relationships on the weekly chart because it has been so bullish, and that means that there's less support to hold it up when that breaks. So if that does break in the NASDAQ, I'm going to be closing out the remaining positions that I have. Right now, I'm not super interested in opening new positions on either of these because, like I said, the further towards all-time highs we get, the more skeptical I usually get in terms of further price movement. But at the end of the day, you have to trade the signals that you are seeing in the chart. If you were a technical trader, you have to trade the technicals because otherwise you're just never going to trade. So what that means for us is really using short stop losses, being very conservative on our entries, making sure that when we do take positions, we have a favorable risk to reward setup, and that we know where we're going to cut the trade loose if it ends up rolling against us. That is so important. Going out to the Russell. The Russell actually had some catch up here, and I'm going to throw this one out to a weekly chart to discuss. Our ultimate breakout here is going to be about 2030. If we break above 2030, this could see some significant catch up to the upside. Both the NASDAQ and the S&P are already pushing up towards their all-time highs, but we have quite a distance here between where it is currently, or that breakout channel at just past 2000, and the all-time highs on the Russell. So if this does continue to push up to about 2030, we get some consolidation there, and then we do see a break above, or if we get a retracement and then a break above, that kind of resets the pivot relationship here and gives us a closer pivot to set a stop loss under, so we're not risking as much on that new entry trade. This might be a very interesting spot of the market to take some potential new trades in the coming week or 2 weeks. So keep an eye on the Russell 2000. And then also similar, going out to the Dow Jones. So this is going to be the first week that I have said I'm actually interested in the Dow Jones potentially for quite some time. I've been basically saying that we've just had a ton of chop. We've had all these moving averages and price has been just going all over the place. But we are actually now solidly above this long-term diagonal resistance zone that is now trying to act and form up as support. Price is above it now, so it's now support. And we also have this price shelf that has developed right here at about 35,000. If we break out of that, we could see a potential catch-up trade and a potential run up towards all-time highs in the Dow Jones. And I think we've finally taken enough time off here going sideways and chopping back and forth that there might be some potential trades here. This has kind of cleaned itself up and has been starting to behave a little bit better here as it's formed up just under 35,000. Last but not least, let's go into a couple of the precious metals and Bitcoin and that kind of stuff. We'll start off with Bitcoin. Going out to daily chart, it has been choppy and messy and just kind of gross in this range for quite a while. We are fighting currently to try to hang on to support here. It's going to be very hard to play anything other than maybe day trades going from the lower end of this range up to the upper end of the range, or waiting for a more significant pullback down to maybe 29,000 or so to buy with a lower risk profile. Or if you want to wait and be patient for a potential breakout to the upside, we're really going to need to see a price close above 32,165. That is the high price of this whole consolidation zone here. So a close above that, and I very specifically say close because we've had these opportunities where the wicks have come up, prices pushed up, and bears have knocked it right back down. So as a technical trader, we need to see confirmation come in, and we need to see the price actually close above that level to signal that yes, indeed, a breakout has occurred. So right now, honestly, just day trading until we actually get a close below this support or we get a close above the support. Until then, it's going to be hard to pick an actual direction. Crude light, if we can get the chart to load. There we go. We had been kind of choppy and in this messy range for quite a while here. We did finally break out of it. We continued to run up into our decreasing 200 period moving average on the daily chart. That acted as resistance. It is pulled back beautifully actually into this channel. It's hard to take this trade right here because even though it is setting up and looking like it has potentially put in a bottom and might have higher prices to come, we do have this resistance channel right overhead. So I would favor probably day trades in this realm more than longer term positions or even swing trade positions, and do little simple quick in and out day trades on this until we resolve above this 77.5 level. Once we get that breakout, the next resistance level is back up here around 83.50. So there is a significant zone from this breakout level above 77.50 all the way up to about 83.50. So I'm interested in a potential developing trade here. Going out to gold. Gold is actually behaving really well, and a break above this 50 period moving average somewhere around 1970 looks like a tradable pattern to me. especially if we get some more economic data coming in, the last couple of economic data pieces that we have that might firm up whether or not this is the last rate hike that the Federal Reserve is going to do or not. If this ends up being the last rate hike that they do, we could see some catch up on gold pretty quickly. So a trigger above this 1970 area and looking for a push up to about 2000 and then maybe even beyond is in the cards. We've had a few days off here, which is nice. I would like to see one or two more if possible, but I don't know if we will get that. But gold needs to be on your radar for a potential bullish trade. And then finally, coming out here, let's look at natural gas real quick. We've been continuing to monitor this turnaround story in natural gas. It's been a little choppy, and I don't really like the fact that it's back below its shorter term moving averages here and that the 9 is crossed below the 20. But that said, a play above this diagonal resistance line is a bullish trigger. So if we get prices that close back above this diagonal line, that would be a potential bullish trigger. And we have a significant run from there. Let's just call that somewhere around 270, all the way up to just over $3. So it's about a 30-cent range on natural gas. And that is a big, big move to be able to catch in terms of the leverage on natural gas futures. So anyways, I hope that helps, guys. Enjoy the rest of your day. Enjoy your trading week. Let me know if you have any questions.